Hello and welcome everybody. I think we're live. Hopefully you can all see us. Welcome to our, I think this is our second in the last little while presentation by the SMB partners. This is not another DPN webinar. There's been so many of them around recently. We really wanted to hop on and have a chat about what we're seeing, what we're doing. We'll definitely go through a lot of the basics, but we think that the value is in, the stuff that you get to have a chat about and what we're seeing and what other people are looking at. Look, I'd like to firstly acknowledge the traditional owners of the land that we're all on today and pay our respects to elders past, present, and extend that respect to all Aboriginal and Torres Strait Islander communities. I'm currently on the ground of the Yuggera and Turrbal people in Brisbane, and Andrew and Justin are in Wurundjeri land, the Kulin Nation, in our Melbourne office. And in saying that, welcome Justin, welcome Andrew today. Lovely to see you all across the screen.
Likewise. Thanks, Alice.
No, it's brilliant. Everybody, we are recording this today. We'll send a recording to everybody who did register on our Eventbrite registration. If you're watching on LinkedIn or on Facebook, you'll find it in the feed that goes back. But if there's ever any questions, just come and ask us. There should be a chat. You can talk to us through the chat. You can also send us an email at any time. We'll give our contacts at the end. And also, as I said earlier, we're wanting this to be a really organic discussion about what we're seeing and how we think that we can offer our sort of pearls of wisdom to the audience today. We'll definitely go through the basics, but all of the information are in our slides. We're happy to share them if we get sort of caught up on any of the more practical stuff. So just let us know how we can help and we will be in touch. All right, kicking off. This is our agenda for today. So, a few of the things that you've probably seen in some of these similar webinars. We'll talk about the recent ATO activity that we've seen, the warning letters. They were really sort of heavily sent out last year. We'll obviously talk about directed penalty notices, lockdowns and non-lockdown DPNs, and also these hybrid DPNs that we're seeing a little bit more of. We'll talk about the liability of associates, small business restructuring, changes to non-lockdown DPNs and payment arrangements, defences, garnishee notices, and practical tips and tricks. But obviously, we're not going to go into the minutiae of each of these things. This is more of a discussion today, and we really welcome people who have comments or queries. So pop them in the chat, and we're really happy to talk on that basis. Look, I'll kick off today by looking at what we have been seeing, I guess, the official stance. We know that COVID-19 led to the ATO suspending most overdue tax collections and pausing issues of DPNs. 52,319 awareness letters were sent as of 13th of May 2022. They were sort of more those warning letters regarding the use of DPNs. And we now know that during 2022, the ATO issued almost 18,500 DPNs in respect of more than 13,500 companies for unpaid GST, income tax, and superannuation guarantee charge. We also know that there's almost 500 clients now that have actually been reported to credit reporting bureaus. So they're clients that owe the tax office over $100,000, and there's a couple of criteria around that. But there was quite a lot of discussion around that before it happened. I think we'd spoken mid last year that there'd been 50. There's now been almost 500. So that's obviously something that's increased in terms of ATO activity. The ATO sort of put out a statement last year, I think it was. They're basically talking about, contacting relevant clients via letter to inform them about their potential personal liabilities under the DPN program. It was sent to clients who had not met their debt obligations in respect of PAYG, withholding, super or GST. And it was basically a bit of a warning, around what the ATO was intending on doing, but welcoming that engagement, I guess, with clients at that early stage to try and sort of engage with the ATO to try and mitigate against the DPM impact. And at that stage, what the ATO was advised, its focus was on making directors aware of their obligations and really driving that engagement. And I think, Justin, I'll turn to you, but I think what we're seeing a lot of now is, whilst the engagement is still, I guess, welcome, it's starting to get a little bit more structured in it, a little bit more formal. The ATO is not, I don't think, as as susceptible to some of those more generous arrangements that it had previously, maybe during the last 18 months or so. Can you tell us what you've been seeing?
Exactly right. So, Alice has just gone through some pretty stark and concerning stats in terms of, hard numbers in terms of what the ATO is actually doing out there in the real world. You add that with the ATO statement, and there's no doubt they're keen to engage, but what that relates to in real life, unfortunately, we're starting to see the opposite. So we're one of many firms, and we're one of three that do what we do. So there's plenty of us around, but I think we're in a really unique position to sort of comment on what's happening out there in the real world, because between the three of us, Queensland and Victoria alike, and Andrew and I cover all corners of Victoria. So we're seeing a really big range of clients, small and large in terms of turnover and operation. But now what we're sort of classifying them into as well is small and large ATO debts. And small and large ATO debts don't always correlate with small and large turnovers. There is no doubt that for the last 12 to 12 months, the ATO has taken about face. They are ultra aggressive. There's no doubt about that. And those stats back that up. I think any of the accountants, even some of the lawyers joining us today, would have probably seen that through their client base to varying degrees. But what we're now seeing, and you can talk till the cows come home in terms of, should they or shouldn't be aggressive, and there's no doubt the hands were off during COVID for all the right reasons. So there's no doubt a bit of catch-up being played. But what we're seeing is the aggressive nature is also, unfortunately, being mixed with a very uncommercial approach as well. So if you've got any creditor that is very aggressive and uncommercial, especially when it's the ATO predominantly is a major creditor, and a lot of the clients we're coming across to try and help, you've left in some pretty precarious positions. Now, has that changed from recent years? I don't think there's any doubt that it has. So what we're seeing time and time again is, I think last count, I had 13 examples in the last month where a client has gone to the ATO, in line with that statement there from the ATO saying, hey, hat in hand, hey, listen, we've got a problem. We want to talk to you about the best way forward. Now, and the accountants will probably scoff at this on the call that are joining us, but it's not set policy. It's not part of their collection process. But I have heard the phrase half up front and the balance over 6 months, and at least 13 times in the last month. Now, that's not legislation. That is obviously a directive somewhere, whether it's stuck up on the notice board in the tea room in the ATO, who knows. Now, if we're talking a debt of $10,000, $15,000, $20,000, some clients, that might be achievable. But we're seeing now more clients where the exposure is 6 figures, and even now we've got a handful that are 7 figures. Now, they, in some cases, have been told the same thing. Half up front, the balance over 6 months. So there is no commerciality to it. That there's no, sophistication. A lot of times they sit back and say, what is in the best interest of, the Commonwealth and the ATO as a whole, and the business community as a whole, if we can wheel and deal with these clients who have come to us trying to do the right thing, as opposed to wind up a company or have a company fall over on its own accord, and lose jobs and recover nothing, we are seeing clients put in positions where they have no option, which we'll touch on in a minute, with DPN issues, but the businesses themselves have been forced into a position where they have to look at voluntary administrations or voluntary liquidations or some of the new options which Andrew will expand on in a minute. And the biggest shift we're seeing too is years gone by, or even not that sort of long ago, a client in an ATO debt position, almost the go-to was, we'll just enter in a payment plan, we'll be fine. But this new approach from the ATO, they're seeing that harder and harder to achieve. So the default position of, well, enter in a payment plan, we'll be okay. Unfortunately, we're seeing those times are changing.
No, absolutely. Thanks, Justin. That's I think really great wisdom for what you're seeing on the ground. And Andrew, you came across some really interesting sort of information recently as well. Do you want to take us through that?
Yeah, Alice, in terms of the ATO enforcement, I think what Justin touched on, their enforcement activities have really ramped up, and they're being uncommercial about, entering into payment plans. And what we're seeing now is the statistics in terms of winding up applications in February are starting to, return back to levels that weren't seen since 2019. So, during 2020, 2021, the ATO really stopped any sort of court action in relation to pursuing debts, where now, those numbers are starting to significantly increase, and they're expected to increase during the next year, which might see those get back to those levels which were historically the case in 2019 and before that.
And we've seen a bit of an increase in the small business restructuring practitioner appointments as well. We'll touch on that momentarily, but I think it sort of just goes to show that there's options out there, but that activity as a whole is definitely ramping up. Look, as someone who tends to provide consents to the ATO and other creditors in relation to bankruptcy and winding up matters, I've got to say I'm definitely seeing the activity winding up, sort of ramping up as well. There's been a lot more requests for consents in those sort of court-driven matters. So I think across the board, we're probably all seeing a similar vibe, but in different ways. So I think that's really, really relevant. Now, Justin, you were talking about the tax officer's, sort of engagement and positions, as it were. We've got here an example of a DPN warning letter. Too many W's for me. A DPN warning letter, which is really different to a DPN. I see it as more of a shot across the bow. But do you want to maybe talk us through sort of what these letters mean and what people are doing, when they're receiving those?
Yeah, exactly. So it'd be hard pressed to find an accountant out there that probably hasn't seen one of these through their client base. The purpose of them clearly was to, as you touched on earlier, Alice, to make directors aware of their obligations, not only in terms of the indebtedness of their company, but also their obligations they have personally, and the fact that it can lead to personal liability, which obviously all three of us will touch on in a minute. And it certainly had that effect. So I remember vividly the week that these first started coming out, our phones were ringing red hot. So I think I was getting 8 or 9 phone calls a day from clients or their accountants who had received one of these. Now, the positive with that is it made people sit up and take notice. Speaking to a lot of accountants out there who knew there was clients with problems or they were a little bit worried about and they wouldn't engage with them, it certainly brought a lot of them out of the woodwork in terms of engaging their accountant and getting the proper advice. Now, a lot of those turned into no action required. So it was pretty clear, and there was a lot of confusion. So they weren't directed penalty notices, which we'll touch on in a minute, just the seriousness of those for those that aren't overly familiar with them. It was basically, as Alice said, a shot across the bow. It was to bring directors aware of their company. It may have a problem and they have obligations. You need to do something about it. And the fact that in the letter itself, it's probably a bit difficult to read for some, but those that haven't seen one, if you want to reach out, we can give you a copy of one for your staff. But what it did, it was twofold. It got clients out of the woodwork to speak to their practitioners and ask for help and say, hey, what is this about? What it also did, it led to a lot of firms taking seriously the serious nature of these and then arming their staff with the knowledge of we need to go and ask clients that, so that the staff that interact with the clients on a day-to-day basis, some practices it's the more junior staff, it led to a wave of sort of knowledge increasing for them from our point of view in terms of educating staff the seriousness of this and what to ask clients. And a lot of firms that we involve with the day-to-day, this event and these warning letters led to us helping them sort of correspond with their clients and send out other letters to clients saying these are coming about. If you get one, don't panic. Here's a step-by-step process. But it is the ultimate red flag. So for some clients that were thought they were hiding from the ATO, again, we'll touch on in a minute that the risks of hiding from the ATO and the right and wrong ways to do that, it was the ultimate sort of heads up that the ATO were aware there's a problem. And if we don't do something, it'll end in tears.
No, absolutely. Andrew, did you have anything to add to that in terms of the sort of warning letters that came out?
I think it was quite clever in the way that the ATO actually worded the letters, because they were worded in a way where it made directors feel like they were already personally liable for the debts of the company, and it didn't offer the steps which they could take in order to avoid that personal liability. So in terms of the success of the process, I think the ATO, from what I've heard, actually recovered significant debts by using these warning letters, because the directors themselves were, they thought they were already personally liable, and it didn't offer them any, alternative to avoid the personal liability. So they either paid the debt or they entered into payment arrangements, which, was quite successful for the ATO in relation to collection activities.
No, that's excellent. it's interesting what all the different methods can do, and sort of getting to the end game in different ways. I think from my perspective as well, historically, the ATO has driven a lot of the liquidations in this country by sort of acting as the creditor in the winding up. But I think also what's happened this time, they've still been quite instrumental in those winding ups, but they've been voluntary winding ups as a result of the receipt of either these warning letters or DPNs, as we'll talk about shortly. So whilst we've seen sort of minimal activity until now in terms of actual court appointments, the actual amount of insolvency practitioner appointments, windings up, VAs, etc., has increased, and it still has been on the back of the ATO activity. So I think it is a really important point to note. So look, what's a director penalty notice? I'm sure everybody on the call already knows what it is. Everyone's been talking about it for some time, but basically companies are required to meet their tax obligations for PAYG, SGC and GST. If they don't, they can be held personally liable, but the tax office has to give them a notice that basically says to them that they were a director at the time that the company failed to pay the withheld amounts, or they became a director after the date, but payment was still unpaid and they were still a director 30 days after that. There are a couple of different types of director penalty notices, and we'll talk about those now. But it's important to note that the liability for directors personally in relation to these tax debts can happen without the receipt of, or can happen upon the receipt of a DPN, but sometimes there's not much you can do about it. So this is the really important part where we're going to talk about the different types of director penalty notices, what you need to look out for you and your clients, but also what can be done on the other side. It's a really important point because, we know, and it's drummed into us throughout our commercial lives, that we have companies as separate legal entities to the directors. So companies, almost in the legal sense, are seen as the individuals separate to the directors. And it's quite difficult to pierce or to lift what we call the corporate veil and to make directors personally liable for debts of the company. And that's why this is so important, because it is such, I try not to say easy, but it is an efficient way for the tax office to really pierce through that corporate veil and attack the personal assets of a director for what would otherwise have been a company debt. So basically, there's some different ways that we can avoid personal liabilities as directors. So look, to avoid personal liabilities in respect of a superannuation guarantee charge liability, you need to lodge that SGC statement by the due date, or for PAYG, you need to lodge the BAS or the IAS within 3 months of the due date, and same with GST in terms of lodging BASs within 3 months of the due date. Now, if you've reported within the required reporting period, you might be looking at a non-lockdown DPN, and there are some options in relation to that, which we'll talk about shortly. However, if those lodgements haven't been made, the only option is to pay the amount disclosed on the DPN. Otherwise, that personal liability is live. And that's, there's not a lot of options by that point. So, a big theme throughout the course of this presentation is making sure that the lodgements are up to date. At least then you have some options. And I don't think that we can stress that enough. So talking to non-lockdown DPNs, Andrew, do you want to talk us through what a non-lockdown DPN is and maybe the options that are available in relation to these?
Certainly, Alice. One thing to touch on the previous slide, though, in terms of the lodgements being, done within the prescribed periods to avoid a lockdown, I think it's really important to understand that whilst the lodgements need to be completed within the period, they need to be accurate. So what we've found on a number of occasions is where the company hasn't disclosed, say, superannuation for a significant period, they've under-disclosed, and then the company's been subject to an audit at a later time. Those amounts which are subject to the audit, where there are amounts which weren't paid and weren't reported, because they weren't reported accurately to the ATO, they actually fall under the lockdown DPN, and that the director can't avoid that personal liability. So not only do you need to make sure the lodgements are done, but you really need to make sure that the lodgements are done accurately. Otherwise, there's the risk of personal exposure.
Thanks for that, Andrew. That's incredibly important.
In terms of non-lockdown DPN, so these are a director penalty notice where the lodgements have been completed on time. So the directors have options to avoid the personal exposure. So it's, once a director receives a non-lockdown DPN, they've got the 21-day period where they can either pay the debt in full, they can appoint an administrator, a small business restructuring practitioner, or a liquidator in order to avoid the personal exposure, but they must do it within the 21-day period. And if you look at the notice here, it talks about the column 2 and column 3. It might be PAYG, which was withheld, but which was reported to the ATO, but which hasn't been paid. So in that period, if the company is placed into small business restructuring that period, then the directors can avoid that exposure. In terms of reality, a lot of the times we probably don't get told soon enough. The 21-day period has expired. So from my point of view, the amount of inquiries we see where that 21-day period has expired, it makes our job a lot more difficult in providing options, because it means once they've lost that period, there really is nothing they can do other than, enter into a payment plan to try and deal with the debt, but they're still personally liable for it, or pay the debt outright. So that really limits the ability they have of actually trying to avoid that debt personally. Justin, I think you'd probably see, and Alice yourself see similar scenarios where, it might even have appeared on, the MyGov portal account for the relevant director before they've even made aware. The accountant then asks that, what's this, personal liability on your own individual account. And, I received this DPN in the mail, like 4 weeks ago. I didn't think it was serious because it was orange, I thought they'd send me a red one before I had to take action on it. And it's, our role normally is just to make sure that we educate people enough so they know when, what's important and when they need to engage with us, to make sure that we can, offer them, a number of solutions so they can go away and make, the decision that best suits them, and their company.
Yeah, look, absolutely. I think the other point to raise with that is to make sure that your addresses are up to date on the ASIC register, because that's obvious. And we'll talk about that in key takeaways, but it's really important because that's the address that any DPN is going to be sent to. So if, you've changed addresses or changed accountants and the address was at the accountant's office or whatever, you really need to make sure that the personal address of the directors are up to date on the ASIC register, because that is what's going to be used for these. We've just got a quick question that's come up here, and I'll pop it on the screen. But what's the difference between appointing an administrator versus a small business restructuring expert? Andrew will have a chat to us about SBRs in a moment, but realistically, they're just two options, aren't they, Andrew, in terms of what's available?
It's just, literally it's two options. So they're both they're two different types of, formal insolvency appointments. So one, an administrator is, a voluntary administration where you're putting the company into administration and we'd act as administrators. And that's where we would take control of the business and, we're responsible for everything that happens after the date of administration. Our job is to try and restructure the company, where small business restructuring is just a different, the new process, which was, brought in by the government recently, in response to the COVID pandemic and the lockdowns and the tsunami of insolvencies that's never eventuated, where the directors stay in control. So it's just two separate types of appointments, which help the director, if it's instigated within the 21-day period, to avoid that personal liability for the tax on that non-lockdown DPN.
Yeah. So the options available, which are the ones listed on the slide and Andrew's gone through, they all have the same effect in terms of preventing that personal liability in a non-lockdown DPN situation. They do, though, have separate impacts on the company and the directors overall. So, Justin, did you want to pop in something there?
Andrew summed it up very well, but I guess to answer David's question as well, so the SBRs is the new kid on the block. So pre-COVID, when we had a company in financial distress, all we had up our sleeve was a liquidation or a voluntary administration. Now, voluntary administrations, for those that have had clients go through it or have been through it or are aware of the process, they can be very costly because they're very, very cumbersome and very involved, as Andrew said, because we have to take control. They were designed effectively to be a cheaper, more streamlined version of a VA. Now, they've probably turned out to be anything but that, but the intention was certainly there. So it's another formal option that we've got up our sleeve.
Yeah, absolutely. Now, Andrew, you're touching on this 21 days, and that's a really important, because that's 21 days from the date of the notice, not the date that you've received it, not the date that you're aware of it. It's 21 days of the date that's up the top of that notice, or that's on that notice. Now, 21 days isn't a long period of time. And Andrew, I understand that you've seen some niggly situations recently where companies have been deregistered and before these DPNs have been issued, and then that's caused a whole world of pain. Do you want to talk to us about that?
Yes, Alex, and I think it's something which hadn't really been contemplated as much, prior to the pandemic, where a lot of companies, just stopped trading, and and they're being deregistered by ASIC without going through a formal liquidation process. Just because they haven't met their annual returns, and they've lodged those annual return statements with ASIC, which means they're going to strike off, the company's deregistered. But the problem is, the ATO has been issuing DPNs, and even where the companies have been deregistered, then the directors have a bit of a problem in terms of how they deal with that, because one solution, they need to reinstate the company before the company can be put into any sort of formal appointment. So they either need to reinstate the company via ASIC, which requires all the annual returns to be filed. They need to pay the penalties and fees associated with that. But then there's also the time period which will take ASIC to go through that process and reinstate the company. And depending on where we receive information about the DPN and how long a window there is, often that's not something which is achievable. The other alternative is an urgent application to court, and that's obviously comes at a significant expense to have to file an application with court to get the company reinstated. And if neither of those are possible, then there's really no easy way for the director to avoid the personal liability. If the 21-day passes, other than pay the debt. So I think there were so many companies, and it's probably a problem which is going to continue to occur into the future, I think, and how we can help clients deal with that. It's probably more education piece in terms of making them aware that if that is ATO are pursuing them for the debts, and if they're aware that the company has been deregistered, they should be taking steps to try and reinstate the company now, to give them time to potentially avoid that exposure, particularly where they know they've met their lodgement requirements, because they can't avoid the lockdown DPNs where they haven't met the lodgement requirements within the prescribed time period. But where they have, and there is this tax debt and the ATO is pursuing it, then I think they need to really think seriously about getting the company reinstated so they can act quickly if and when a DPN's issued.
I think that's right. With so many zombie companies, we were all talking about zombie companies about 12 months ago, and how many companies sort of weren't doing anything, and they were just sitting there almost waiting for those two, defaults on the ASIC registrations or renewals, so that they would just be deregistered at the end. And everybody, sort of had an opinion as to whether that was a good idea or not, given the cost of liquidation. But we're now finding that there's actually significant problems, not just with the ATO, isn't it, Justin, but with other creditors as well. When these companies have just sort of lapsed into deregistration, it can cause some issues.
Exactly, and everything Andrew said is spot on. But another, I guess, like a lot of what we're going to discuss today, there's the legislation requirements and the do's and do nots, but then there's other real world complications. So not that we ever condone it. So people will lob on our doorstep, and we, with our instructing solicitor or accountant, and trying to help their client. Now, we will run through options in terms of what they can do with their company, from informal to formal. Now, not that we ever condone it, but another option that people often run with is the do nothing option. Now, the do nothing option can sometimes solve the problem, because you stop lodging ASIC annual returns, the company's deregistered. They sit back and say, well, the company's dead. No one will chase it. Now, for some people, that's fine, because a creditor, if they did want to look at taking action, they would have to meet the additional cost of reinstating it and then applying to wind it up. And most creditors won't bother doing that. The ATO included, in our experience. But the example Andrew's just given, and we are seeing it firsthand, where they have to reinstate it to then put it into one of the options there before us, to cover their backside. Now, if you can actually achieve it within the time frame, and you've got the ability and the funds to do that, the biggest complicating factor we're now seeing in real life is, for those that help clients complete their ASIC annual returns, one of the things you need to do when you actually fill those out on an annual basis, or when you're going to catch up on the ones you haven't lodged, is they need to sign and acknowledge that the company is solvent and will be for the next 12 months. So then they're with a dilemma. They have to sign a document saying the company's solvent to reinstate it, knowing full well there's a tax debt there. They need to wind it up. So We've had some clients in that predicament where they can achieve that, but they have the sort of almost a moral dilemma in terms of a little furphy for ASIC to cover their backside. So it's never as straightforward as it seems.
No, absolutely. Thanks, Justin. And we'll stick with you while we talk around lockdown DPNs, which are really the notice that's sent out. That is the be all and end all, isn't it? There's not a lot of options once you get to one of these.
Correct. So those that have joined us today that have sat in meetings with any of us, and me in particular, they know that one of the first questions we'll ask any client, apart from is there an ATO exposure, we then very quickly ask what's our compliance history like in terms of lodgements. We don't care so much if there's a debt there for obvious reasons, but if lodgements are up to date in terms of within 3 months or on time with SGC. And the reason that is important, if basically the horse is bolted, there's no other way to describe it. So if we have missed the boat in terms of our lodgements, there is a debt there and we issue one of these notices, the only option you've got is to pay the debt. Simple as that. Otherwise, it will transfer to the directors personally. So a lot of the time, our job is to help our direct clients, being the accountants, the solicitors, the financial counsellors and the bankers, is to help them make their clients better off. And unfortunately, if we've got a significant ATO debt there and we've missed the boat from the lodgements and a lockdown DPN is in play, there is nothing we can do, that anyone can do, to avoid the personal liability.
Yeah, no, I think that's really important. You know, the only option there being payment of the debt in full. Where it can get a little bit confusing, I found as well, is with these ones. So these are hybrid DPNs and they can come out from time to time where there actually is an element of them that is a non-lockdown DPN. However, there is already a portion of that notice that is subject to the lockdown provisions as well. I'm not sure, Justin and Andrew, if you've seen too many of these, but it can be quite confusing in terms of people sort of trying to appreciate, well, what's the next step?
Oh, exactly. And we are seeing that, there's no doubt. It complicates things a little bit, but it's just, I guess it's our job is to sort of break the options into bite-sized chunks for the clients and their advisors alike. So as I said before, our job is to give clients options that make them better off. And one of those options would be, say in the earlier slide of a lockdown DPN, if the ATO is the major creditor in a liquidation, if we've been dealing with a company that say has $1 million worth of debt, 800,000 of it is the ATO, and a lockdown is in play, then you would argue they're probably no better off in a liquidation scenario, because on paper, $800,000 is going to transfer to them anyway. So they're not really better off. The hybrid option, however, it comes back to that sort of, I guess, putting pros and cons ticks in boxes in terms of are we better off or not, because in theory, there will be a portion of lockdown and non-lockdown. So the lockdown we're stuck with. The only way out is to pay that amount. But again, in that earlier example, if 800,000 is the tax debt, and let's say only 200 of it is lockdown, then the remaining amount, if we can tick the box and lodge, and the examples Andrew ran through earlier in terms of the options to avoid the liability, then we're in that sort of funny position where we might be left with some liability, but we can get rid of some of it if we follow the 4 options available. So, and again, this isn't a gratuitous plug for us or any insolvency practitioner, but the hybrid DPNs is probably the biggest example of, if anyone receives one of those, you have to jump on the phone to us, whoever you prefer to use, and just sound out exactly what it is and just break it into bite-sized chunks, as I said. What components are we stuck with? What components can we actually deal with?
I think it helps add a bit of certainty as well. Like, you know, when they get the hybrid DPN, we can sit down and really help them and explain exactly what their, you know, the lockdown portion is, what's not locked down, what can they try and avoid. And one thing I've seen in practice recently is where the figures have been wrong. So column 5 is the lockdown column, and, you know, make sure the accountants go back and check, you know, when lodgements were made, you know, because the ATO, you know, have been known to make errors in DPN. So making sure that, you know, the figures are accurate before you start, you know, considering your options as well. Because, and even sometimes, you know, whilst they might not have the information, accountants, you know, always say, get an extension for the due date, because that increases the period before the lockdown applies. So it's something which, you know, lodge on time where you can't seek a formal extension, and then make sure you get it in to avoid that personal exposure.
No, excellent. That's yeah, really good wisdom. Thank you. It's important to know that it's not just the current directors that are potentially liable and have that personal liability exposure for DPNs. I won't go through the slide word for word, but basically it's important to know that, you know, former directors, potentially new directors as well, can be personally liable for debts of the company that was incurred prior. And also associates. You know, sometimes we talk about de facto directors and shadow directors, but also associates and related parties can be liable. So it's not just good enough to think, well, I'm not on the ASIC register, or I've just got on the ASIC register, it's not my problem. You need to be really aware around the liability of associates. If you need any further information on that, we can go into it a little bit deeper. Andrew, I'll talk to you, or turn to you now, in terms of the small business restructuring framework. We touched on it really briefly earlier. Do you want to have a chat around sort of what the ecosystem around these SBRs is like and what you've been seeing? I think your information that you sent through the other day had a bit more information that they're becoming a little bit more prevalent.
Oh, 100%. I think this, you know, when, you know, Josh Frydenberg stood up there, you know, at the end of 2020 saying, you know, these are going to be the most significant reforms in Australia's insolvency, you know, framework in 30 years. And they've come into effect on the 1st of January 2021. It's, you know, there really was a slow uptake, you know, in terms of the utilisation of the small business restructuring process. A lot of the time it's because, you know, the directors would come to us, you know, too late, and they just either weren't eligible for the small business restructuring, or they didn't have sufficient funds available to be able to put towards a plan to compromise their debts with their creditors. And, you know, from what I think Justin mentioned this earlier, in terms of being another tool in our, you know, our toolkit, which we can utilize. And it's really is a fantastic tool, I think, for those small businesses where a voluntary administration isn't, you know, the right size appointment for a small business. And often if someone approaches us, you know, where they're trying to salvage the business and they don't have, you know, significant assets or funds available, you know, we can't continue to trade the business. Where in a small business restructuring, the whole model is a debtor in possession model. And I think that's the key to the changes. From a voluntary administration, we're in control. Small business restructuring, the debtor remains in control. So the director stays in control of the, you know, the business while it goes through the restructuring process. And I think that's, you know, the key, I guess, ability to for us to try and help the business get through is they stay in control. And our job really is to assist the director through, to try and help them formulate a plan that's likely to be accepted by creditors. And I think, and now what we're seeing, you know, particularly in the last 6 months, is those numbers start to increase exponentially. And I think it's just more about, you know, knowledge of the process getting out there, and probably some of the misconceptions about the process initially. You know, I think it was, you know, initially it was sort of framed in a way that it was, you know, this effectively this process which was right for everyone, and, you know, you're eligible and you get rid of all your debts and everyone will be, you know, will be happy. And it's where now it's, well, it's, you know, got these strict eligibility criteria where debts need to be, so liabilities need to be under $1 million, employee entitlements need to be paid, which are due and payable, and all your tax lodgements need to be up to date. So some of those hurdles can be quite difficult for some businesses, and it only really fits the right business that's looking to, you know, looking to continue, restructure, and hopefully move past some of the things which happened, you know, during COVID lockdowns and debts that might have accrued, particularly to the ATO, and move on with, you know, profitable businesses into the future.
No, absolutely. And I think, you know, you were saying then, you know, the eligibility is the debts of $1 million or less than $1 million. And when it was originally, well, I'm just going to put up Anthony Kokolas' comment because I think I'm about to answer it, Anthony. So it worked very well. When it was originally touted, we were actually talking about $1 million in unsecured debt. It was actually then slated as $1 million total debt, which is what we're dealing with now. I personally think that that's not big enough. I actually think that if we were to use it more around that $1 million in unsecured, I think that's probably about right. But I do understand that that's really quite difficult to legislate. Anthony's here noted, you know, everyone's been talking about the $5 million. I think that's about right. I actually think, especially with the way that inflation's going and how, you know, we've had a lot of deferred debt, landlord or leasing debt as well. I do still think that it's a really relevant process for many small businesses that do have debts of up to $5 million. Justin, what are your thoughts?
I couldn't agree more. And it doesn't take a lot these days, as you said, Alice, for a small business to accrue that sort of debt. Because early days, you know, the draft legislation was $1 million unsecured, then it turned out to be $1 million total. A a small business with significant equipment finance, for example, it's not very hard, especially in the agri space. It's not too hard to get above that very, very quickly. Whether it becomes a mil unsecured or 5 mil, there's no doubt that will have a massive impact. Even our practice alone, so Andrew made the very good point about it, was slated, so SBRs were slated as this sort of fix it all. So any business impacted by COVID, you have to go down this path. Now, we had numerous clients come to us in the early days of the SBRs saying, my solicitor or my accountant told me to come to you to do one of those SBRs because my business was impacted by COVID. Now, even if they did meet the criteria, it was then a matter of, well, is this a viable business? Well, no, it's not, but this will buy us time. So then again, it was sort of education that it's SBR is to basically save a company we think is worth saving, essentially. But there was, for every one of those, there was 2 or 3 people that came to us who probably had the funds and had the ability and the correct guidelines for going down this path, but they didn't meet the criteria. And so it was very, very difficult to explain to people that their options then are voluntary administration, which, was hard to justify given the size of their business and some of the debts, or liquidation, which was an option because it's the terminal option.
No, absolutely.
So there's no doubt that it needs to change. And look, the 5 million I think would be on the money in terms of, I think that would save a lot of companies that need to be saved.
No, I agree. Andrew, what are your thoughts?
I agree. It needs to be changed. I think the fact that it includes contingent liabilities as well. Often you look at leases and potential liabilities that would flow on from leases. There's significant debts which do accrue. So the fact that increasing it, if it's going to open up the process to more small businesses, then I'm all for increasing it. I'm not sure 5 million is the right number, but I'm sure government will land on a number which is appropriate. But obviously it's a process which is it's designed for small business, and just making sure that it is there for small businesses, and I'm sure the government will set an appropriate figure.
Yeah, no, absolutely. Thank you, Anthony. Great question. Very relevant. All right, so just moving on quickly, we've had some changes in terms of the Clifton decision. Now, this relates to payment plans and the opportunity to enter into payment arrangements with the tax office. With that, this case here actually really solidified the position that whilst after a DPN has been issued, directors can enter into a payment arrangement with the tax office. After that 21 days in a non-lockdown DPN, or not at all for a lockdown, but after the 21 days in a non-lockdown DPN, the liability to the director, the personal liability to the director still stands, notwithstanding that a payment arrangement was entered into. I think there was some confusion for a little while that, if you had entered into a payment arrangement with the tax office during that 21 days, and that was a valid option and that personal liability would come off. This case has solidified that that's not the case. So it's really important sort of for that early engagement. By all means, enter into a payment arrangement. It might mean that the sort of, any further action isn't forthcoming as quickly, but it doesn't negate that personal liability. And Justin, you tell me that much long ago, there actually was a valid option, but it has changed, and it's important for everybody to understand that, right?
Oh, exactly right. So, and this was probably no more prevalent than when the sale presentation we discussed on the DPN warning letters that came around. So we had numerous occasions where the client, in a panic, rang the accountant, and they were told by the accountant, "Don't worry, if and when we do receive one, we'll just enter into a payment plan, and that'll be fine. That'll fix it. We'll just pay them a couple $100 a week. It'll buy something and problem solved." And that's clearly not the case anymore, and that case supports that. But where a lot of that confusion comes from is that back in the early days of DPNs, that was one of the options. So the options that Andrew ran through before in terms of pay the debt, all the 3 formal options, way back when, entering the payment plan was actually one of the options given to you on the early DPN. So within the 21 days, if you entered into a payment plan, that was sufficient to cover the director's backside. So again, just an example of the ATO sort of moving the goalposts a little bit, and some accountants unfortunately being caught out, and as a result, their clients being caught out.
And so really the crux of it is, by all means, engage and try and get a payment plan if that's relevant, but try and do that before any DPN is actually issued. And that way you're sort of extending those time periods available. That's right, isn't it?
That's right. And again, it harks back to, if the debt we're talking about is a smaller, less immaterial debt. So we're talking $20,000, $30,000, $40,000, which is obviously big numbers, don't get me wrong. But if the payment plan will see that amount paid off in a 6 to 12 month window, then it's okay. But if the figure we're talking is 6 figures, or as I said before, sometimes more now, the payment plan, if it's not going to resolve the debt, it's not the fix at all that it once was, or that unfortunately some people think it is.
Yeah, no, perfect. There's also defences to director penalty notices that directors can consider. These can be quite difficult to lock down, also no pun intended, but it's very difficult to rely on, I should say, these defences. It's important that directors seek early legal advice to try and understand what is really required to be able to take advantage of some of these defences. But Andrew, you've done a little bit of research into these as well. Do you want to sort of talk to us about what you found? Yeah,
so I think in terms of the defences, what the cases suggest is that it's just very difficult to rely on the defences. So, illness, you need to be ill throughout the whole period where the debts are incurred to the ATO. It can't be just a discrete period, during the last 6 months I've been sick, when the company incurred debts over a number of years. So they are difficult in terms of the directors being able to rely on it. In terms of took reasonable steps. In terms of reasonable steps, it's not suitable for them just to say we weren't able to get a resolution forward, to appoint a small business restructuring practitioner or a liquidator. It's the bar is really quite high. And in terms of superannuation, one of the statutory defences is if you had reasonable grounds to suspect that, there was no superannuation owing, on that basis, you need to be quite confident in the reasonable steps and the reasonable understanding that there was no superannuation. And if a reasonable person in that circumstance, should have been aware that the super debt was owing, then you can't rely on the defence. And the last one was the estoppel defence, which, that's just where representations were made by the ATO representatives. I think one of the cases was where the ATO representatives had made representations that they wouldn't pursue the debt and they'd extend the period in which they had to comply with the DPN. Then that wasn't obviously the case. Then they pursued them personally for the debts. And then the ATO was found to be stopped from pursuing the debt because of they effectively had allowed this extension. Yeah. And I think that's the thing where now that's probably not so relevant, where the last case, when you looked at in terms of the recent case law and, the underlying debt still being due and payable, and the payment plan, is now off the table in terms of, an option to avoid the personal liability, that probably estoppel scenario is unlikely to happen where the payment plan's off the table.
No, absolutely. And just in terms of garnishee notices, it wasn't that long ago that these were the flavour of the month out of the tax office. We were seeing sort of garnishee notices all the time. They seem to have been set aside a little bit now. There's obviously some interesting stuff happening in the background around the ATO's position on garnishee notices. My understanding is that sort of delegates at a much lower level can actually issue DPNs now as well. So they are seen as the collection tool of choice, and we're seeing many more DPNs than we are garnishee notices at the moment. Justin, have you seen a garnishee notice for a while?
It's been quite some time, but like the DPN warning notices, when they come in a flurry. So, and look, they're just around the corner. So there's no doubt they can now be issued from I think a lower level within the ATO, as can DPNs for that matter. And again, it's a tool the ATO has to basically frighten people into action or collect their debts. Simple as that, or both. So it has been, I'd say, a couple of months since I've seen one. Again, given how active the ATO, and as I said before, how aggressive and uncommercial they are, I'm surprised I haven't seen any for that period of time. But I can guarantee I'm only probably we are all only a couple of weeks away from seeing one, and when we do, they'll be coming in a flurry. There's no doubt.
Yeah, no,
I think the ATO in terms of garnishees, the negative publicity in the media regarding the impact of the garnishees really, I think, stopped the ATO from using it as, because they are quite a powerful tool for the ATO. End of the day, they can even, lock down assets, cash at bank debtors, and they are crippling for businesses when they're issued. So it really, is the ATO, utilising its powers, which even we can't claw back as, liquidators. If the company is to go into liquidation, we can't claw them back as unfair preferences. But because they are so crippling, I think that's why the ATO more recently has moved away from the garnishee notices after the negative publicity towards the DPNs, which, it really puts the decision on the director to say, well, you need to make your decision regarding this debt. Either you do something, otherwise you're personally liable for the tax debts. So it's really putting the decision in the hands of the directors rather than the ATO really using the heavy hand of the garnishee. And I think that's probably why they've started, with the softer approach since the COVID pandemic with DPNs.
No, I think that's, absolutely. All right, so we're coming to the end. I'm conscious of time. If anybody does have questions, please pop them up in the chat. We've got some time for questions in a few slides' time. I know that it can sometimes take a little bit of time to type those in. Practical tips and tricks. Justin, what are we looking at in terms of some really key things that people need to be aware of in terms of DPN?
Yeah, absolutely. That top one, for something so simple, I think that we've seen firsthand the catastrophic impacts of not having that right. And every presentation I've done with accounting firms or discussions with accounting firms and their staff, that is probably one of the most simplest things we can check, but it can have such ramifications if not done right. So the notices we've gone through, ASIC will send these notices to the directors, care of their address per ASIC's record. So your stock standard company search will show Justin Howlett of X address. Now, that address per ASIC records is where they send the notice. Now, if Justin Howlett moved house 2 years ago and never got the notice, it's irrelevant. And it's been tested in the courts. The ATO is allowed to rely on that address per ASIC's records. So if it was sent to Justin Howlett's address and Justin Howlett never got that notice, it doesn't matter. 21 days starts ticking from when it's sent, and that's it. We are liable. And we've had numerous cases where the first I've ever heard of it is when the ATO starts to take action, and then we trace back the chain of events, and it was issued to an old address. So it's something so simple to check. I know there are some accounting firms that historically had the accountant's address per their, like a registered office, have it care of the accountant's office. There are some that have moved away from that for this very reason. But it's one of those things, something so simple that we can just check. And I know some accounting firms have gone through and done an audit of all their clients just to check that such a simple fact. And again, act quickly. So like a lot of things, any company where there's a whiff of any financial distress, I like to say that there's never a too early, but there's often a too late to put your hand up for help. Whether it's ringing us, another IP, if you can't speak to your preferred supplier, ring us or vice versa. You've got to speak to someone and get advice. And even and Andrew made a really good example before of the DPNs that are just left. The director gets it and doesn't action it because it was the wrong colour or I didn't think it was serious. The human nature element of clients who are in financial distress is they tend to ignore mail. ATO letters will be unopened and filed suitably in the bin like everything other creditor notice and demand that they get. Once they open a letter and they see the ATO letterhead, then it can be just ignored. Now, again, it all comes back to education. So educating clients in terms of anything from the ATO, even if it's just a statement or an RBA or just it could be run of the mill. Anything to do with the ATO, you've got to give us a call. You've got to find it. And then if the accountant, the lawyer, the financial counsellor, the banker then wants to jump on the phone and ring us and say, hey, listen, we got this notice. I think it's okay, just checking. Scan it, take a photo, send us to one of us three for a quick look. So, yep, no, that's okay. It's just one of the warning letters, or it's this or it's that. Or if we're unfortunate enough to actually get a DPN, but we are lucky enough that it's a non-lockdown, then we have action. We have options and we can make the client better off. Simple as that. And the biggest one, even if we can't pay, lodge. I've had examples even this week where a client, with the power of hindsight, has been left in a horrible position because they and their accountants decided that if we lodge the BAS and we can't pay it, it'd be a red flag to the ATO and they'll come knocking. So let's just not lodge it. Now, I don't agree, but I follow the logic, but armed with the knowledge that we all have here today, and I'd like to think no one in this call would sort of make those decisions anyway. Something so simple, had we just lodged anyway, then this $200,000 debt could have been crystallised and killed off with a liquidation or an SBR or whatever it might be. But now they're left holding the baby literally purely because we didn't lodge the BASs.
Absolutely. Thanks, Justin. Just one thing I wanted to raise with that, and it just harks back to that important address thing, but we've all seen recently as well in terms of the Australia Post, looking at its position and taking longer to not do daily, daily mail outs or deliveries and these sorts of things. And even if people have got redirections on their addresses, it can take a significant period of time for things to change. So it's just so important to make sure that source address is correct. Understanding that it's, it may be in, it's the postman's bag or the postperson's bag, and it's not going to come to you. It doesn't mean the time hasn't stopped ticking. Andrew, did you have anything else to add to that?
Just, you guys have probably covered off most of the practical tips. One thing which did come up recently was an accountant had spoken to the ATO regarding, so they've received a DPN. The accountant wasn't, fully across, how the DPN regime operates. And they'd asked the ATO, regarding, the personal liability and the options they had available. And the ATO representative told this accountant that, the PAYG was associated with JobKeeper, therefore they couldn't avoid the personal exposure when they'd actually received a non-lockdown DPN. And putting it into like one of the formal appointments would have actually avoided the, the personal exposure. And then it took a conversation with me, just a chance conversation with an accountant who I hadn't really worked with frequently at a discussion group. He just said, "Can you just confirm how this works?" And I said, "No, that doesn't sound right." And then they rang the ATO again and got the appropriate response. And, they could have gone ahead thinking they had to pay it, that debt, which I think that's why early engagement and speaking to someone like us really, or any other IP trusted advisor who specializes in insolvency, it's really giving people the options about, what options are available and how those options would, how they would impact that relevant person in their situation. I think that's, the benefit that we can provide is really giving them, an understanding of what options are available, and then they can go away armed with the knowledge to make an appropriate decision.
No, look, absolutely. Look, we've got some key takeaways on this slide. We've been talking today about the ATO ramping up its activity. I'd just like to sort of mention that from what I'm seeing as well, it's not just the ATO, we're seeing a lot of creditors now who are actually sort of taking a lot more steps to recover their debt. I think in terms of where interest rates are at the moment, and cash is starting to get quite tight, if it's not tight already. So there's a lot of businesses who are really enforcing their debts at the moment, and we're seeing more and more of that. So I do think that people who are in that sort of, we're starting to have a little bit of trouble, or we're starting to sort of, look at our cash flow forecasts, and there's a little bit of distress coming. I think it's really important to, to take advice early. This is what we've been saying the whole time, by a trusted advisor, and sort of really understand what your obligations, but also what your options are. Justin, any other key takeaways for today?
No, I think that's it. As I said before, and it sounds like a broken record, but there is never a too early to ring one of us, but there can always be a too late. Like, but the peace of mind, even for the practitioner themselves, let alone their client, just to pick up the phone, ring one of us and say, "Here's the position. Is there something to be worried about? Is there something we can do now to help, or is it just a matter of sort of writing it out and sort of doing the best we can?" It can take 30 seconds on the phone, and that 30 seconds on the phone, like Andrew's example, could actually save a business and could actually save someone's livelihood in terms of preventing, a significant debt transferring to them personally.
Yeah, absolutely. Andrew, anything further before we turn to questions? Andrew?
Top slide, I think, is the key. One of the keys. Can you hear me?
Yep. Sorry. Yes.
I think the last point. I think the last point in terms of the directors looking at their options before putting personal assets in, and I think for me it's engage early, but look at all your options, and before you put your personal money towards paying off debts, look at how they might be utilised for a small business restructuring or another voluntary administration with a deed of company arrangement, because once you put that money in, it's too late to really go back in time to, offer up, a compromise to your creditors. And I think that's why it's key to get in early. We can give everyone, the directors, this is all your options available. This is how you could potentially utilize those funds you might have parked, in your personal equity in a house or something which you could utilize, to try and put forward a plan to your creditors and then help the business survive into the future.
No, absolutely. All right. We do have one question on the slide for now. Anthony is curious about how creditors are affected by SBRs. Andrew, did you want to take this one?
So secured creditors in an SBR, so the SBR regime is very similar to the voluntary administration regime. So there's a decision period where secured creditors have to make a decision, within a period if they want to appoint a receiver. But likewise, if they actually do vote in favour of the SBR, then they are bound by the terms of it. So if they don't vote, then they're not bound by the terms of the SBR, which is very similar to the way the VA regime applies.
Excellent, thank you. We don't have any other questions in the chat for now, which is fine. It's excellent, actually, given the time that we've got. But I just want to stress that, the three of us are always available to answer any questions that you might have. We can do that on a very general basis, or if you've got specific scenarios that you'd like to discuss, we can also do that. We'll put our contact details up shortly. Or if there's anything else that we haven't raised today, we're happy to look at that either via separate training or to answer your questions on notice. Before we go, snapshot back of the envelope. Justin, do you want to tell everyone who we are?
Yeah, certainly. So there's a lot of familiar faces, names joining us today, and some new ones as well. So there's probably nobody with us today that's not familiar with insolvency practitioners and what we and they do. So essentially, we like to classify ourselves as a one-stop shop, and that's not to sort of put down what we do, and certainly not sort of drawing similarities with the sort of jack of all trades, master of none either. So basically, we see ourselves as basically a safe set of hands in times of need. As I said, our selling point is that we're always just a phone call away to sit down with you, the practitioner, or your clients, or both. We don't charge for initial meetings, however long it takes. If we have 3 or 4 pre-planning meetings just to get the facts straight, break it into bite-sized chunks, help the client understand where they're at, what they can and can't do, but more importantly, some options that will make them better off. That's what we do, simple as that. And we're very open. So we back ourselves in to give the best advice and the right advice. And if for whatever reason that client wants to take that advice and do it with another IP, we welcome that. So we pride ourselves in giving the right advice, simple as that. Our job, and whilst we're a resource to your clients, we're as much of a resource to you yourselves, and your staff understand how you can make your clients better off.
No, that's fabulous. Thanks, Justin. This is our disclaimer that we need to put in terms of the general nature of any of the discussions we've had today. And just finally, this is us, this is our emails, this is how you can find us. We're not that hard to find. Google us, Google SMB. We're pretty easy to contact. I'd really like to say thank you to everybody who's joined us today. Thank you very much, Justin and Andrew, for the chat. This has been really good. I think we've had a lot of wisdom to share, and I really appreciate our time. And as always, if anybody ever wants to reach out, please feel free. But otherwise, have a fabulous day, and I'm sure we'll talk to you all soon. Thanks. Thanks, Andrew. Thanks, Justin.
Thanks a lot.
Thanks, guys.